In this video, I'm going to assemble a portfolio consisting of just 11 FTSE 100 shares, which will meet the following criteria. Firstly, the average share price will have beaten the FTSE 100 over the last 5 years. It will currently generate a higher dividend yield. It will pay out dividends every single month. It will be diversified and cover every sector of the market equally. And I'll be achieving this with just 11 shares. The Global Industry Classification Standard, or GICS for short, divides the market into 11 sectors listed below. I'm going to select one company from each sector to give a relatively small portfolio, which is balanced and diversified. If you bought the complete FTSE 100 index using an ETF, you would of course cover all 11 sectors with just one share, but it wouldn't be balanced. You can see on this graph that 19% would be in consumer staples, 18% in financials, but only 1% in sectors like technology and real estate. This means you would be overexposed in some sectors and underexposed in others. The portfolio I'll be showing you today will be equally balanced in all sectors because I'll be choosing just one company from each. Now, this is not investment advice and is purely for entertainment purposes only. So here we go with our FTSE 100 Diversified Dream Team. In goal is the healthcare sector, and we need a company which will sell its products regardless of the economic outlook. For this critical position, I'm going to choose AstraZeneca, a company I've owned for over a decade. The share price has increased a massive 125% over the last 5 years. A company which is unlikely to go bust anytime soon, and its essential medicines are sold regardless of the state of the economy. Dividend yield is 1.9% spread over 2 payments a year. Over the last 10 years, AstraZeneca has maintained a fairly stable dividend. If you like these types of videos, then please give the like button a quick tap and subscribe for future content. In central defence, we need a couple of robust companies who do well in both good and bad times. First is in the utility sector and is the captain of our side, National Grid. I've owned National Grid for over 12 years. The share price is up 24% over the last 5 years and the dividend yield is a decent 5.3%, spread over 2 payments a year. National Grid is one of those companies which raises its dividends year after year. And partnering National Grid in central defence and representing the industrial sector is BAE Systems. The amount governments commit to defence remains fairly stable throughout all economic cycles. The 5-year share price is up 54% and a dividend yield is 2.8% spread over 2 payments a year. Dividend payouts have been increasing steadily in recent years, and this is another company I've owned for several years. On the left of defence is the consumer staples sector, and I've gone for British American Tobacco. This company is 120 years old and has been in the FTSE 100 since it was created. The shares are having a tough time of late, down 34%, and the dividend yield is 9% spread over 4 payments a year. Apart from a couple of blips, this company has a decent track record of growing its dividends over the long term. At right back is the only technology company in the entire FTSE 100. The name is Sage, and it sells accounting and payroll software. The share price is up 39% over the last 5 years, and a dividend yield is 2.1% spread over 2 payments. Since 2012, Sage has increased its dividend payments every year. Now I can almost sense the cheers of delight for this next one, as bossing the midfield in the centre of the park and representing the financial sector is the investment management and pensions company Legal & General, which is the second largest institutional investment management firm in Europe. The share price is down 15% over the last 5 years, but the dividend is a whopping 8.4%. And as you can see here, Legal & General has a good record of raising its dividends each year for the last decade. Also in central midfield and representing the consumer discretionary sector is the packaging and paper manufacturer Smurfit Kappa. The shares have slipped 7% over the last 5 years, but they pay a reasonable dividend at 4.1%. The dividend growth looks excellent, with Smurfit Kappa raising its dividends every year since. On the left of midfield is our pick for the communication sector, Airtel Africa. This company is only 13 years old and is Africa's leading provider of mobile and 4G services. The share price is up a huge 90% and a dividend yield is currently 3.4% spread over 2 payments a year. You can see here that the company has only been paying dividends in the last few years. On the right of midfield and representing the real estate sector is Segro. This real estate investment trust or REIT develops and invests in property, focusing on edge of town, flexible business space. The shares are up 15% over the last 5 years, and they pay out a moderate dividend of 3.5%, spread over 2 payments. Segro has managed to grow its dividends each year over the last decade. Up front, we have a real dynamic duo. Firstly, representing the energy sector is Shell. Shell has operations in almost 100 countries and produces around 3.7 million barrels of oil a day. The share price is down 10% over the last 5 years, but the dividend is a reasonable 4.4%, spread over 4 payments a year. And partnering Shell up front and representing the basic materials sector is the metals and mining giant Rio Tinto. The shares are up 27%, and despite a recent dividend cut, the yield is still a big 7.2%, spread over 2 payments a year. Dividend history shows a few blips, but the long-term trend is upwards. Now let's compare the performance of this team with the FTSE 100. Currently, the average FTSE 100 dividend yield is 3.7% a year, and our perfectly balanced dream team is higher at 4.7%. If you were to buy a FTSE 100 tracking ETF, you would receive quarterly dividend payments, but our dream team pays out every single month. At the time of this video, the FTSE 100 is down 1% over the last 5 years, but our dream team is up 28%. So who pays out and when? Well, in January you would receive 1 payment from National Grid. February is 2 payments from British American Tobacco and Sage. There are 2 payments in March from Shell and AstraZeneca. On into April and we get a nice Easter nest egg from Rio Tinto. In May we have 3 payments from Segro, Smurfit Kappa and British American Tobacco. In June there are payments from BAE Systems, Shell and Legal & General. In July it's Airtel Africa handing out the cash. 2 companies pay out in August, British American Tobacco and National Grid. September is always the big month for dividends, and as you can see here we have more than half our entire dream team paying out this month. In October Smurfit Kappa comes to the rescue. November is BAE Systems and British American Tobacco's turn to pay out. And finally in December we get a Christmas bonus from Shell. And now a quick word of caution. Although our dream team is balanced equally in all sectors, there are risks, especially having just 11 companies in a portfolio, and this is not recommended. You can see here the individual companies I have in my own portfolio, but in addition to these I also invest in a range of exchange-traded funds to increase diversification and reduce risk. So for many people who are perhaps starting their investing journey, ETFs may be the way to go. But the main message I want to put across in this video is that just because you are buying an entire index, it may not be as balanced and diversified as you think. Now, it is often said that to become wealthy, all you need to do is buy more assets and fewer liabilities. To see how, then click this video here.